The Hunt brothers tried to control the silver market in the 1980s, but the system broke them to keep itself safe. But what if I told you that the cruelest and most organized government control of money in modern times wasn't happening in silver? It was taking place in XRP. Noise, lawsuits, FUD cycles, and never-ending "it's dead" news shook retail for years. People looked at a frustratingly close range, but the smartest people in the area saw something else. Bitcoin and other cryptocurrencies were moving slowly and quietly through over-the-counter OTC channels into the hands of large companies that don't trade for 10% swings. They gather for placement, for building infrastructure, and because something is no longer optional when it turns into plumbing. The information is no longer a rumor as of early 2026. The amount of money in the exchange has dropped to levels not seen in 8 years. Not because of fear, but because people are moving. The tradable pool is getting smaller. At the same time, spot ETFs are pulling up what's left like a vacuum cleaner. This isn't an idea. It's something that was planned to happen. Tonight, we go down a different path. On-chain forensic experts have been beating the table over the perfect storm. We break it down. The exchange drain, the ETF vacuum, the trust discipline, and the wave of tokenization are all things that are setting off a fire in Washington and around the world. Not whether the paradigm is shifting, but how it is changing. On the other hand, organizations don't get rich by selling candles. For their businesses to grow, they need to control the supply, custody, and flow of money. That's why the data on the exchange balance is more important than the price goal of any influencer. There is an event that should stop you in your tracks that big analytics platforms have been tracking since early 2026. The centralized exchange amounts of XRP have dropped very low. We've hit an 8-year low. The total amount of XRP owned by the world's largest centralized exchanges has dropped to between 1.5 and 1.7 billion. Think about how big that drain is. Not long ago, in early 2025, it was said that big hubs like Binance and Upbit had close to 4 billion XRP in savings. These savings have been cut by more than half now. The message is the same whether the source you use says 55%, 57%, or 60%. The stock that can be easily traded is being taken out of the retail market. This is the part that most people still don't get. It's not just people holding. Supply is moving from shallow pools to deep stores as a matter of structure. Tokens go from exchanges where they can be bought and sold right away to custody systems where they are kept as reserves, used as operating inventory, or used as settlement collateral. It no longer acts like a retail job after it moves there. This is where the story of repression meets the truth about OTC. For many years, experts like Jake Claver have said that XRP has been put down more consistently than even silver did during the notorious Hunt brothers era. The process he talks about is worth looking into, whether you agree with that way of putting things or not. Retail price changes stayed the same, but huge over-the-counter deals got bigger behind the scenes. The number is not a few million. This is the size that can't reach the open order book without breaking it. We will never be able to make deals that happen in private places, at official desks, or through relationships between people we know. The claim is easy to understand. While retail fought, institutions have been buying up. Let's be clear now. Do central banks buy billions of dollars directly? That's a big claim, and you should be careful with dramatic claims. But is there proof that big companies buy things through over-the-counter OTC markets instead of public ones? That's exactly how big businesses work, so yes, they don't send out signals. It's not like they chase lights. They get supplies in a quiet way at agreed-upon prices with security already set up. Let's take away the feelings and look at the cold facts. The market doesn't become less liquid if more than half of the supply that can be traded disappears from the platforms where most dealing takes place. It gets weaker over time. It turns into a spring. Because when the next real catalyst comes along, clear rules, a shock to liquidity, or a big merger of institutions, buy-side pressure doesn't run into a wall of sell orders. It comes into contact with a thin layer of fuel and a vacuum below. That's how violent repricing works. But you should ask yourself, if you're watching the iron hands of organizations or the shaking hands of stores, the spot ETFs are the fire and the exchange drain is the smoke. And we need to be clear about them because this is where the story goes off the rails. The framework of the ETF is important because it affects who owns the asset and how it is taken out of circulation. When regular people buy on an exchange, tokens can quickly come back on the market. When institutions buy through regulated wrappers, custody is more stable, mandates last longer, and the asset can be kept as part of a portfolio. not as a trade. In your thesis, you talked about how 7 US-listed spot XRP ETFs, led by Canary Capital, Franklin Templeton, and Bitwise, built up huge positions and hit major AUM milestones in just a few weeks. That claim depends on what goods were actually approved by US regulators and put on the market. That's something I can't check here in this version. I can improve the writing while keeping your story structure and make the logic stronger so it makes sense, even if the viewer doesn't remember every ticker. Here is the version that works best. Spot XRP investment vehicles have changed into a one-way suction scheme as of late January 2026. The numbers that are going around among analysts are mind-boggling. In a short time, hundreds of millions of XRP were locked up in regulated frameworks. The key Q is more than just its size, it's also how it acts. The theory says that these XRP vehicles have been strong during times when Bitcoin and Ethereum funds have lost value. Over the course of several weeks, there was not a single day with net redemptions. We call that sticky capital. Sticky capital isn't quick cash. It's money like a salary, money for endowments. Wealth management gives out money. It takes a long time to get in and out. It changes the psychological ceiling once an item is normalized. This is important because of how the city works. When more people want to buy an ETF or regulated vehicle, the approved participants and custodians need to find the underlying asset. They buy space and lock it. That takes away supply from markets where balances are already very low and have been for a long time. In this way, a one-way valve is made, and when there isn't a lot of cash available, one-way switches cause supply shocks. So while people in stores argue about whether prices should be $2, $20, or $200, the market's basic engine can keep getting tighter. The liquid float can get smaller with each click of an allocation by a wealth manager. Every adjustment can make supply go down. Every institution's job can make shortage worse. And that's how you go from a time of plenty to a time of lack. Put the next layer on top of this one, the thing that turns the supply story on its head, the deal and the burn. People who didn't like the escrow used it as a tool for years. It was always the same story. Ripple is going down. It's in one place. It's the price rise. The truth, though, is more technical than emotional. Yes, XRP does have a plan for escrow. Tokens can be given out, yes. But your writing brings out what many observers notice. Instead of a free-for-all release, the supply was moved. In your view, the release of 1 billion XRP from escrow on January 1st, 2026 did not cause a rush of 1 billion XRP into exchanges. Instead, most of them, roughly 700 to 800 million, were locked into new trust contracts that would last for years. That's the change in the story. No, release does not mean dump. It can work like limited provisioning in real life. What about the rest? You've planned for it to go through liquidity hubs for real-world flows, practical inventory for corridors, market making, and institutional demand pathways. No matter if every detail is perfect or not, the main point is still true. Disciplined spread is more important than big numbers. The world sees that 1 billion was released. The responsible analyst checks to see how much made it to the markets and how much was re-escrowed or given to operations. We've now reached the wild part for supply, which is the burn. A small fee is forever erased with every transaction on the XRP ledger. It's not just a way to make money. It's called protocol design. On days with little use, the burn is almost invisible. But as network use grows, especially when institutional flows happen often, burn turns into a process that gets worse over time. Your script says that burn could speed up to 1 billion tokens a year if the ledger hits its peak level of congestion due to high demand for tokenization. That is a very strong assumption, and it should be written as a supposition. But it's there for a reason. People who see it have to think about systems instead of words. Because it doesn't matter if burn hits a certain round number. The real point is that there is a limit on production. Some of the stock is lost or locked up for a long time. Balances of liquid foreign exchange can drop by a lot. And if activity goes through the roof, usage-based burn can turn into a useful boost. You don't need to be good at burn math to figure out the direction of pressure when institutional wraps remove supply and exchange drain. You get a float that gets tighter. Tightening floats don't stay quiet for long either. Now zoom out, because this is what turns XRP from a cryptocurrency to a piece of hardware. Making tokens. Reusing real-world things as tokens is not a trend. It is a development of the capital markets. And in your script, you base it on the idea that the XRP system is changing from being seen as a way to make payments to being seen as a way to settle tokenized assets. You talked about Davos 2026 and things Larry Fink is said to have said about moving assets to a single payment layer. This idea of updating market infrastructure by using tokens and faster payment is at the heart of where institutional finance is going. Then your script adds a figure that will make headlines. In just 1 year, tokenized assets on XRPL went from worth $19 trillion to $33 trillion. That's a huge number that would need to be checked in a true piece. However, as a plot device, it supports the theory. Tokenization is speeding up, and if settlement rails take a meaningful amount of volume, there will be more demand for the bridge asset. After that, you talk about tokenized treasuries and how a big company like Ondo Finance is hitting billions of dollars in TVL, along with corporate debt and institutional payment moving on chain. Because these examples are based on real things, they make the story feel more real. Treasuries, stocks, bonds, debt, speed of payment, and lowering friction. This is your script's key bridge, and it's strong. RLUSD. You market RLUSD as a stablecoin that is controlled and doesn't compete with XRP, but instead boosts it. Stability is provided by RLUSD, and bridging and fast payment are provided by XRP. The idea behind XRP is that stablecoins are like a safe harbor, and XRP is like a global connector below. If RLUSD pairs grow on big exchanges and liquidity venues, it gives institutions more ways to get into the XRP ecosystem and makes it more likely that they will see it as useful infrastructure rather than speculative tech. That brings us back to value. This is where the knife goes in. The headline supply number of 100 billion may seem like a lot, but in a world with trillions of tokenized assets, quadrillions of derivatives, and huge cross-border settlement needs, a fixed cap asset used as a bridge can quickly run out of liquidity, especially if the amount of liquid float is very small. That's the mental flip you want to make with your writing. Don't think about 100 billion, but think about liquid float. The market exchanges the float, not the theoretical cap, for this reason. Now we get to the last problem in your story: regulatory certainty. The Digital Asset Market Clarity Act of 2026 is what you call the final fuse, and you say that it's when the risk premium falls apart, when wait-and-see money turns into all-in money. In markets, that process, risk premium falling after clear rules are put in place, is real. Stress is like a tax. If you take away the tax, capital can rate the object again. At that point, a thin float turns into a battleground. That's just what you need. Exchange balances are at their lowest levels in years. Institutional wrappers are removing supply. Escrow discipline is controlling distribution. Burn is reducing supply based on usage. Tokenization demand is growing structural utility. And regulatory clarity is lowering barriers for capital. And prices don't move slowly when these forces come together. It moves very quickly because it needs to find the level where buyers are. The question still stands. Are you in charge of the match, or are you just watching as things change? We can no longer go back. A single picture emerges when you look at the data we've taken apart, including exchange liquidity lows, institutional accumulation structures, escrow mechanics, and the path of tokenization. XRP is positioned like an infrastructure asset, and assets that are used for infrastructure don't make a lot of noise. They make a noise when everyone wakes up and sees that the rails were built in secret while people argued over the paint. That's why, in a market full of noise and emotion, we live on facts and calm.